Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, March 16th, 2020. It is 2:52 p.m. Eastern Time as I'm starting the video, so that should give me enough time to wrap it up, get it out to you guys before the close. I wanted to start out here by mentioning my change in stance on that QQQ official trade. I had for quite some time. We went into there originally with, as a swing trade with some set targets. Rapidly saw, both the technicals, meaning the charts, and the fundamentals deteriorating, and figured there'd be a lot more downside. So I extended the targets and morphed it into what I call a runner trade with more downside potential, targets to be determined, and I'll tell you, that's still, there's a good chance there's more downside. But upon further review of the charts, and that's what I'm going to go over in this video, I decided that the risk reward for remaining short just wasn't very favorable at this point. There's that old expression in the stock market: bulls make money, bears make money, but pigs get slaughtered. So I didn't, figured probably shouldn't be a pig. And the problem too with this market right now is some of the biggest gains and losses each day are coming via big gaps with the futures overnight. So again, it's all about risk reward, and again, this doesn't mean we can't drop, but I figured go ahead, take the money and run. We have a better than a 16% gain from where we re-entered. Regarding being bullish when we should be bullish and bearish when we should be bearish. We've swung this up pretty good and down. Going long here on the bottom, getting out, playing the bounce trade, and then capturing the bulk of this next trend down today. We just missed. I previously had T2 set just above that 169 level. We came very close today, but didn't quite get it. So let me go over some of the things I see and provide my reasoning. And as always, I will say this: these are just suggestions, things that the way I'm, what I see, and where I think things might be going. And I'm also trying to manage the official trades for those in it, that I know everyone's not a very active trader like me. So I say, I take most of the trades posted on the site, but sometimes I'm in and out. I can't take them all. Sometimes I don't take a trade for one reason or another. Maybe I have another proxy related to it. Maybe I'm fully invested in that sector or whatever it is. But in this case, yeah, I did cover and actually just with that time reversed, and I'm gonna see if I can see what happens before the close today. And of course, I like to trade the futures, so I can kind of keep tighter tabs on that trade overnight. The only time you really get stuck in the futures, Monday through Sunday night through Friday evening, that is lately when we've had these lock limit down periods. But when that's coming too. You can see when the futures are about to hit the lock limit down values, and then you can always manage that position accordingly. Okay, so let's talk charts. Just real quick, and you probably saw the notes in that post that I made when I closed out the QQQ short trade for the 16% profit. I migrated the server over the weekend. When market volatility like this spikes, you have everyone that's currently members. Those that aren't very active, they're coming into the site, checking everything out. Gold members are more active in the trading room. Comment section's more active, and so therefore, what I did is I over the weekend on Friday, I contacted the web hosting company and migrated, paid to upgrade the site to a much more powerful, dedicated server, meaning it should run faster and prevent, especially those bottleneck times when everyone's logging in. So I didn't realize, as I said there, they didn't inform me that when they do the migration, they left both servers running until everything was on one. And long story short, yada yada, they're trying to restore all the posts from, I think it was Sunday night, probably some point over the weekend. They dropped off the old server today, which the site, I didn't realize was running until this afternoon. So anyways, that's why you've noticed, some of you noticed in the trading room, your trading room posts in the last couple days are gone, and some of the front page posts. So hopefully by the time you get this video, those posts will be restored. Like I said, we'll work on that. That's just a minor technicality. But I'm going to go over the charts that I posted. Really what it was is last night, Sunday night, I posted these potential bear market targets, additional downside targets. And again, I want to reiterate, I think these, at least these next targets at minimum will be hit over time. Right here, 157.30 on QQQ on this weekly chart. and quite likely 143.68. But it's a matter of how do we get there? Are we going to continue to fall? Like I said, the S&P 500's down into today's lows about 30%. Yes, yes, yes. Very rapid deterioration in the market, in the economy, bad technicals on the charts, everything else like that. But it's more of a matter of, how do you get to these things? Are we really going to drop 40, 50% in just a few weeks? And so there's, I don't think so. I'm just going to say it that way. I'm going to give you this just straight out. The cross currents right now are the risk of a hedge fund or some type of financial institution, possibly a brokerage firm, a bank, with their hands in the market, lending money out. There's the energy industry blowing up. A lot of those companies have loans through banks. So there's some repercussions here, and you could see a chain event. It could be a single event. It could be a couple that trigger a larger chain. And so the downside risks are what I'm just talking about now, something blowing up in the financial system, be it a fund, a large fund that triggers a lot of forced liquidations when they blow up because they were overly leveraged, or maybe a financial institution. So those are your downside risks that could certainly take this market lower. Again, don't underestimate how oversold a stock or the market can get, especially at times like this. This is unprecedented as far as how rapid the economy has turned from firing on all cylinders to firing on virtually hardly any cylinders right now. We've never seen that in history. I've never seen it since I've been around. You can go back in points in time. You can go back to World War II when Pearl Harbor was bombed, brought the U.S. in the war. You might say, "Wow, that was certainly one of the biggest events in modern history, for U.S." But guess what? That doesn't even pale to this. This is, businesses shutting down left and right. Cruise ships aren't sailing anymore. Most of their flights are being canceled. Events around the world are being canceled. Sports leagues are shutting down. So we've never seen this. Go back to Pearl Harbor. What happened is opposite. Everyone went to work. Men went off, joined the military, went off to war, and the women, those guys that stayed behind worked in the factories, building tanks, planes, guns. And that was the opposite of what's going on here. That led to productivity. It's a horrible time, but I just want to say, if you're trying to compare major events, there's nothing like this. Even when the planes hit the towers on 9/11, sure, the world came to a standstill at that point in time. Planes were grounded and all that, but then started flying again a few days later, and things got back to normal. That was for all intents and purposes, not to it all sound callous, it was a tremendous tragedy, but it didn't stop people from getting out and going to a restaurant, going on their vacations, and doing what they do. It certainly knocked the market down temporarily, but again, from a fundamental perspective, it was different. So I just laid out the potential downside risk. Now I'm going to tell you the upside risk in the market, or the upside, the risk of staying short. Okay, you've got not just the Fed, but every central bank in the world and those in power that have such a vested interest to keep the financial, the cogs of the financial machine flowing and everything spinning and working, because of everything I just said. We keep going down, the financial system will break, the banks will break, hedge funds, brokerage firms, they will break. Okay, we cannot. So you're going to see everything, and you've already seen a lot coming out with the Fed, what they've done both yesterday and just over a week ago, and you're going to see whatever it takes, whether it's a ban on short selling, and again, this may have a temporary lift, but it could be very powerful when the market is down 30% in just a couple weeks. I'm going to go over to SPY here, and there's my and by the way, at support, which I should have just mentioned here, these are nice long-term. These are my weekly charts. All day we fell to that support about 173 on QQQ, and so far all day we've held there. Now, it could just be a temporary speed bump on the road down to the next one. It very well may be. So why I'm telling you the reason that I'm pulling in that short. I also think it's maybe a little too early to go long. You can certainly take a speculative position, but if you're trading QQQ or SPY, and even the futures, there's a good deal of risk. But with QQQ or SPY, you are subject to whatever gap whichever direction this market's going to gap tomorrow. It's most likely going to gap up or down, and it could be, as you saw today and in recent weeks, a very large gap. So I'll let you guys decide what to do. I'm not going to add this as a long trade right now, but like I said, I just think it's prudent to book some profits. So there it is. You have QQQ at support while down off the highs. It's a little less than the S&P 500 because these are tech companies, and they're not for the most part. The Nasdaq 100 is so tech heavy, it doesn't have as many restaurant and service sector stocks and airlines and everything like the S&P 500. So you're down still about 28%, almost as much as the S&P 500. But the thing about those tech companies, they're going to feel it, and they're going to get sold down with the market when there's forced liquidations and forced selling. But if you look at it this way, when was the last time? Or I should ask, have you stopped going to the Facebook store or to the Microsoft store or to the Google/Alphabet store lately because of coronavirus? No. Why? Because they don't have a store. You never went to a store. In fact, if anything else, you're Googling more. You're using Google more. You're on there all the time, Googling about coronavirus, Googling about what sporting events in your area or other events are shut down, what grocery stores are open, who has the toilet paper, that kind of stuff. And so, it's not going to have nearly the impact on Google and a lot of these tech companies because they don't have the physical stores. Due to the way their businesses are structured. So that's it. So in a nutshell, let me say this, and I'm going to move on to show you some other charts. Here we are on the S&P 500, down, as I said, about 30% in just a few weeks here, back to levels that we haven't seen. It was last trading at back in early or was trading at last trading, you can say right here in the 2018 meltdown, but we can take it all the way back and we're trading at the same level we were in the beginning of 2017. So there's 3 years, just over 3 years of gains wiped out in the stock market. So if you want to look at it from a valuation perspective, and this is what the smartest people in the world are trying to do, as well as those that are, I'm talking about hedge fund managers, and no, I shouldn't say the smartest people, but those that are in the industry, as well as you and me. And if you're if you're wondering on how to figure what impact is this coronavirus really going to have on these companies, a very simplistic view is say, are their earnings right now, are we going to knock earnings back to where they were back then, or valuations? Now, the thing about the stock market, the pendulum always swings too far in each direction, meaning during a bull market, you overshoot where valuations should have ever gotten to. They get excessively high. And at the end of a bear market, think 2009, March 09, their stocks are extremely cheap. And of course you have more of it's the supply dynamics. You've washed out most of the weak hands in the end of a bear market, and at the end of top of a bull market, you've blown out most of the shorts, and you have just everybody all in long, and there's really nobody left to buy, everybody left to sell, and that's why you get those big drops. And of course this one again, I will say, although it was priced into the charts and has been pricing in for a long time here with these divergences that have been building since that top back here early in January of 2018. That's when the negative divergences started, and they certainly played out. We had a smaller but still very big divergent top back in the fall, early October of 2018, led to the biggest drop in the bull market up to that point. And then what happened from there? Well, we went to new highs, but like I said, these divergences only grew larger and more ominous, indicating a much larger drop to come, and this was simply the catalyst for that. And so if there's one positive takeaway, and there's really not a lot of positive I can spin with COVID-19, but if the one thing is, it maybe got the market to where it needed, or at least at this point got us to where we needed to get or need to be faster than it would have been. Had we not, we might have been meandering down. All right, so that's it. Look, next support zone right here. That target zone runs from about 232 to 240. We're right smack. We're right on the top of it. Well, we bounced, reversed off the top of it. Little momentum fueled overshoot under the 240 level, up there now. And if that goes, I still maintain this target, as I said earlier. To me, it's a matter of do we bounce first, or is there something bad? I think the only thing that's going to do this now, I shouldn't say the only thing, but I think the most likely thing to just take us here this week is if something really bad comes out. I heard rumblings, and it's just a rumor. We'll see if it pans out. That next day or two, probably be tomorrow. Washington's gonna put an outright lockdown on the U.S. No travel and all that stuff, like what Italy has done. Again, I don't trade off rumors. If it materializes, great. And again, it's risk reward. So how much? Let's say that target's hit, and that's very, very good support. So let's say the S&P 500 drops there from where we're at today. Let me try to grab this low from where we hit today. That would be about another 10%. Now we've bounced. We're bouncing because I'm doing the video a little, so that now also, off the where we're at right now, closer to about 15%. And that's a lot of downside. But from where we were today, let's just say now that the Fed and Washington have come up with a plan to somehow gun this market, whether they're going to start stepping in and buying stocks outright instead of just buying bonds, creating liquidity that gives the banks money and they gun the market. And it puts liquidity in the financial system. But you can also, I could very well see a 16% upside right there or so from today's low. So what I'm looking at is I'm just kind of doing this probabilities, and I'm seeing about close to equal odds of a pretty powerful short covering rally coming up soon. And even if I want to give it a little tilt it to this downside, which whatever, whether 50-50 or 60-40, what's the difference? It's just not worth it. Again, especially for those of you guys, and I know a lot of you trade ETFs, not futures, to get caught in here and give back a 14% profit on that. I'm sorry, a 16+% profit from where we closed out. Some of you might have closed out this morning on that big drop, and kudos to you. You would have got a little bit better than that, but that's it. So let me not beat a dead horse here. In a nutshell, the markets are extremely oversold. By the way, this is the most oversold reading. We're at 24, about 24.5 on the RSI 14. This is a measure of how overbought or oversold the market is. The last time that we were down there, look, you can see in the bull market, we've never crossed under it. Last time we crossed down below that was right here in 2008, and there was more downside to come. The correction when we got about to that level, if I have to look at the crosshairs, right about there, there was a few more weeks of selling to come. But after that, we had a little selling climax followed by a bear market rally of about 28%. Okay, so you don't want to get caught on the wrong side of a 28% rally. And like I said, in this market, the way I trade, I have a very, what I call anticipatory trading style, if that makes sense. I anticipate moves. I like to be proactive instead of reactive. That's why you guys probably notice a lot of my trades, I'll catch falling knives, or at least try, with the proper stops in place. I like to get in front of moves quite often before they've even turned, before the bottom or top is usually in, if I think it's pretty likely. And again, there's a lot of other things that go in, risk versus reward. So you take a shot at some of those falling knife trades. Just don't give yourself a 10-20% stop loss on it. Keep the stops tight. If you nail it, the upside potential, because those are the explosive trades, like gold, for example. If that one happens to pan out, that's certainly a catch a falling knife trade, and we'll talk on that right now. Let's go to that. GLD, that was on the daily time frame that we entered that, and our parameters are right here. I've got a board. There it is. So again, picking this one off that target. That support about 136.37 with a relatively tight stop compared to our third target, and this one I may add if it pans out. What I think will happen is I think if the stock market rallies, you might be thinking, okay, Randy, well, wouldn't gold go down because it's a flight to safety risk or a flight to safety asset? It is possible, but remember, the correction in gold was based on two things. Number one, it was technically induced. Most importantly, you can see here, I'll draw it here clean for you. We had divergent high, clean negative divergence, not just on the daily, but also on a more significant weekly chart. We've been diverging up here, and finally those divergences played out. Now, the thing is, gold Although it is often a flight to safety asset, meaning people flock to it, institutions or individuals during stock market corrections, it has been rallying in line with the stock market. Remember, gold peaked back here, March 9th, and the stock market peaked on February 20th, not too far below it. So they were both rallying here. So here's my theory: is that well, it's pretty clear, pretty apparent that those that are heavy into the stock market, or were heavy, and we're seeing this deleveraging margin call for selling, they'd also been buying gold in their accounts. So I think a lot of this was, and we may have more to come. Like I said, it's either going to work out or not, like any other trade. Don't get married to it. Don't put too much money into it. It's just one of, I don't have a ton of trades on the site as official trades right now, just a handful, 3 of them, I believe. But it is one of just several. And if the markets break here, the stock market breaks, or some big failure, some big financial institution, think Deutsche Bank, think whatever it is, whatever, that's the obvious one, or one of the obvious ones, but you can see all the banks are getting clobbered today. XLF is down big, still down over almost 11%. JP Morgan, largest bank in the world, largest in the US here, so it's down 13%. This is not good. These are banks that have their hands in the cookie jar in the stock market, these big mega banks, and so they're down big, and this is certainly a concern. So like I say, I cannot overemphasize enough the risk of the market snapping. And so if you want to keep a short on QQQ, absolutely, it may work out. You may double your profits from what we've already had, or wherever you shorted it. And like I said, I'll look to add this back. It's another trade, either long or short. Maybe we bounce back to resistance. I'm just looking at different boards here. Maybe we bounce back to resistance, get a recycle in, just like we did back here. We had been short back here. I can't remember, that was official, unofficial, pointed out there, being short. Reversed here. We did an official long there, closed it, and then a couple days later, right around the same level, we reshorted and rode this wave down. So that's swing trading, and really trend trading if you look at it. I was talking about a much longer term trend, holding it out, but we captured the bulk of a 25, 20+% drop so far. And like I've been saying, this market, trading a bear market, especially this one so far, is like trading a bull market with your remote control on the fast forward ×5 button, or whatever that max speed is when you click on like Netflix or something, and one of those streaming things, and you can click the button and increase the fast forward speed. So that could be it for this trend, and like I said, up to you whether you want to let it run or not. But I feel better just taking that one off the table. Now I'll talk about LQD, because that's one of our other trades. Will LQD likely rally with the stock market? Yes, it's doing that today. That's what it tends to do, because when the stock market rallies right now, nobody knows. Even the smartest of guys out there. I haven't listened. I don't watch CNBC. I don't turn the TV on unless there's something, I see a huge move in the market and I wasn't aware of it and seeing what's going on. I'm not getting the headlines. I'll usually read from the Journal, Barron's, Bloomberg, get my information online, and once in a while I'll turn the TV on to see if there's what happened, or during a rate cut, what the Fed had to say. But what I was getting at here is, the smartest of smart people don't know what's going on, because this whole coronavirus thing is new. But what I can tell you is that in the very near term, people are going to flock to kind of following. They'll take the cues from the stock market. If the stock market's rallying really hard one day, that will, at least initially here, correlate to a rally in LQD. And LQD did recover a lot of the losses today. This is a bond ETF, but look at this, swinging 5%. Never used to swing like this in the past. These are the biggest candles. You can go back as long as this thing's ever been out there trading, and you won't see candles like this. To me, this is a pretty clear chart. This is broken. And what I had warned about, I think it's already set in stone. the fact that we're going to see a lot of those triple B bonds being downgraded. So I'm going to give this one room, unlike the QQQ trade. I'm going to, and besides that, if you look at it this way, although right side of the chart is not a at all, it's not intended to be a what do you call it, a a full complement for your portfolio. In other words, I don't put out model portfolios, take every trade here and you are well diversified, covered in all asset classes. No, I share trade ideas, and those are just take them or leave them. Supplement your own trading, supplement your own analysis, your own investing, but by all means it's not supposed to be a properly well-rounded, diversified, all-weather portfolio. We only have, again, a few trades. LQD, gold, and QQQ were active trades. QQQ was closed out today, and a short on QQQ and a short on LQD is very much an overlapping trade. It is a bet on continued deterioration in the fundamentals of the economy and in the technicals in the stock market, in other words. So however, but I do believe that when we get the next rally in the stock market, which could start today, could start tomorrow, or sometime this week, we'll see, that I think we'll get probably a little more upside in LQD. They might even run and take out our stops. And I might expand that. I had a relatively tight stop, but I do think that the damage has been done. This is a broken chart. Corrections usually don't end like this. This looks to be the first wave down in a correction with more downside to come in the coming weeks to months. So let me just leave it there and show you that this is what it looks like. We fell back within. This was our divergent high. There was our breakdown of the trend line. There was the confirmation of the what I call the bear trap or bull trap, I'm sorry, aka false breakout. This was a breakout to new all-time highs, breakout of a very, very powerful multi-year trading range, as I talked about. We fell in it and boom, very impulsively down to the lower 2/3 of the channel or so, the lower third I should say, and we're in it now. And I really doubt we just take on up, run on up here like it never happened. The downgrades are yet to come. The impact on the economy with everything that's already happened with coronavirus is still yet to come. Those earnings reports won't be out for a while. When they come, they're not going to be good. The market's already priced a lot of that in, obviously. The big question is, where do we go from here? So I'll be watching that. I'll be watching the ebb and flow of the news, the headlines, fundamentals, what goes on. And I may decide to pull this one in early, and if they hit our stop before unless I revise it ahead of time, then so be it. They take it from us, and we've already made a huge profit on the the previous short trade that we had. Not huge relative to corporate bonds. We caught the bulk of the biggest move that they've ever had in history in such a short period of time. Got in right before it happened, got out right before the first big bounce. This is a weekly chart. You can't even see it there, but there it is. That's where right here is where we covered recently, and then recycled in somewhere right about here. So maybe we're back to about break even now or somewhere. I think we shorted right around here. And so that's it. Still have a little buffer there, and I guess that's it. Let me wrap it up here. There's not much else to say. Like I said, so basically, in a nutshell, I am personally, and both and on the website as well, reducing, taking some profits and reducing net short exposure to the market. Because although these are bonds and these are usually trade inversely to the stock market, that's the thing about it. It's kind of ironic. That's usually you put your money in corporate bonds or treasuries when you think stocks are going down because they should go up. But again, this is, I think, the bigger impact we're going to see more so than interest rates or anything else will be the continued deterioration in the fundamentals and downgrades still yet to come by the rating agencies that are going to force a lot of those bonds at that triple B investment or triple B low end investment grade rating to be downgraded to junk status. So I think if you give this one time, I believe it'll pay off. And if not, then look, we're back near break even in our entry, wherever that was, somewhere around there, and our stop is not even 3% above. So even though it's a double weighted position, it'd be a total net about 6% or so loss if it's hit. And again, if I don't modify it until then. All right, guys, let me wrap it up here and get this video out, and pick it up tonight. Well, I'm dying to see how this market closes today, and and then of course how it picks up tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.